Many clients have been asking a similar question, and that is, are we due for a market correction? Markets have been strong this year, particularly in technology and AI-related companies, and there is a lot of commentary around whether prices in this sector have run ahead of reality. But at the same time, we've had mixed economic signals, so it's natural to wonder what comes next. Hi, I'm Lynn Williams. I'm the owner of The Lifestyle Protector, and we help busy professionals and business owners get clear, gain confidence, and make positive progress towards retirement, whatever that might look like for them. Today, I'm going to talk about what's happening now, what needs to happen for things to stay on track, and what you can do for yourself to stay on your track. So let's start with what's happening now. Markets have been generally resilient this year, supported by strong corporate earnings and ongoing innovation, especially around AI. And that optimism has pushed parts of the market higher, sometimes very quickly. When enthusiasm builds like this, we often see short-term pullbacks. Not because something is wrong, but because markets rarely move in a straight line. These ups and downs are part of how investing works over time, not necessarily a sign that something is fundamentally wrong. So in this circumstance, what needs to happen for things to stay on track? So there are three important factors to watch. The first one is corporate earnings. Corporate earnings need to continue to grow. So earnings are the foundation of market performance. And when companies are making money and reinvesting and expanding, that supports stock prices and overall economic growth. So far this year, earnings have been coming in better than expected. And if this continues, the likelihood of a correction is reduced. The second thing that needs to continue to happen is interest rates need to remain stable or generally ease. Stable borrowing costs allows families and business to plan and invest confidently. We don't need dramatic cuts, we just need predictability. A slow, steady environment supports continued growth. And finally, what we need is productivity needs to improve, especially through technology like AI. With slower population growth, future economic progress depends on doing more with the same or even less resources. And if AI improves efficiency and reduces costs, the economy can grow without pushing inflation higher. That is the long-term opportunity. But in times of uncertainty like this, what can you do for yourself to stay on track? And for long-term plan-driven investors, there is really no such thing as a market crisis. There are temporary declines and periods of recovery. And there are a few important things that you can do to stay on track. You've probably heard them before, but they are foundations of building long-term wealth. So the first point is build your financial decisions around a plan. Your plan is built for your life, your needs, and your future. It guides the savings, the investing, the spending, and the progress you are making year by year. And a well-designed plan is built to withstand declines and grow through recovery. You don't change course just because the news is noisy. The other thing is focus on what's important. It's helpful to remember that while a market correction may feel uncomfortable, inflation is far more damaging to long-term wealth. A correction has always been temporary and markets have always recovered. Inflation, however, is permanent. It permanently reduces your purchasing power. Avoiding temporary declines by moving to safety often locks in returns precisely when your money needs to stay ahead of rising costs. So the greatest risk is not short-term volatility. The greatest risk is falling behind inflation. So focus on that. Stay invested also in quality companies. One of the most damaging mistakes happens when investors moved to perceived safety after unsettling headlines and then miss recovery. When your portfolio is diversified across regions, sectors, and focused on quality investments, it reduces the impact of downturns and supports more consistent long-term growth. And finally, use tools like dollar cost averaging. If you're contributing regularly, you benefit from dollar cost averaging. You naturally buy more when prices are lower and fewer units when prices are higher. And this works in your favor through periods of volatility. The market is not your path. Your plan is your path. The market will rise and fall over the years. That's simply how investing works because it follows economic cycles. So staying focused on your plan, not the headlines, keep you moving forward with clarity and confidence. And the objective is not to avoid temporary fluctuations. The objective is to stay on your path to long-term financial confidence and prosperity. My work here is to help you stay on that path, thoughtfully, consistently, and without being pulled off course by short-term noise. And when reassurance is needed, that's exactly what I'm here for. Visit our website, lifestyleprotector.ca, for more insights and conversations.